What is real estate business all about? It has become commonplace to hear claims that Alan Greenspan actually caused the real estate bubble and subsequent credit crisis by reducing interest rates to 1%. The following article challenges that claim, widely stated as fact but without a shred of evidence. The American Industrial Revolution was one of the greatest examples of free market capitalism in world history. Yet it was accompanied by the panics of 1814, 1819, 1837, 1857, 1873 and financial crisis of 1907. At that time there was no Federal Reserve to blame. Even on the gold standard, where money, credit, interest rates and inflation remained stable in this country for a century, we still had financial panics. Why? It is fashionable to blame Alan Greenspan for the housing problems and credit crisis. The charge is that Greenspan took interest rates to an artificially low level that created wild speculation. On the face of it, the argument seems reasonable. After all, aren't 1% interest rates one of the lowest rates in modern history artificial? Surely this unleashed waves of new home buyers and ignited artificial credit creation that couldn't exist otherwise. When the Fed funds rate was lowered to 1%, the 3-month T-bill was at 0.90%, which means the free market rate had already fallen dramatically before the Fed lowered its target rate. The 10-year bond was 4.15, also unusually low. There was nothing in the interest rate structure that indicated an easy monetary policy. All interest rates across the board were in simultaneous free fall due to the deflationary trend. This was also true worldwide, as the long rate fell to the lowest worldwide rate on record. At the time of our housing boom, there were booms in 26 other countries, each with varying degrees of economic and monetary policies, all with much higher interest rates than the U.S. We were somewhere in the middle of the pack in terms of home price appreciation and duration. We were not the first to turn up or the last to turn down. Major housing booms occurred all over the world simultaneously. Obviously, the worldwide housing boom transcended us interest rate policies. Japan had 1% rates for over a decade, yet not only was there no housing boom, there was a generalized deflation. Most mortgages around the world are tied to the LIBOR rate, which ranged between 4 and 5% during the boom years. There was a greater housing boom in most of those countries than there was here in the United States at 1% rates. Us 30-year fixed mortgage rates are tied to the 10-year bond rate, the Fed had no control over. If you think otherwise, explain why nations that experience high interest rates don't simply force them lower. Why? They can't. The 10-year bond is set by investors throughout the world. The Fed can only influence short-term rates like the prime rate, 0% teaser rates and artificially low adjustable rates, which are what supposedly caused the real estate bubble, are the domain of private lending institutions. And while the Fed does have a certain influence over the prime rate, it has no control over the lending practices that exist in financial institutions, regardless of what the interest rates are. The Fed certainly has no control over fraud, abuse, false home appraisals, false mortgage ratings, the marketing of these loans, ignorance or incompetence. The credit problems that have occurred are a private market creation. This happens from time to time as part of the business cycle. The resulting problems should be met with free market solutions wherever possible and handcuffs wherever appropriate. Instead, we looked for a scapegoat. Finally, during the Greenspan years, the price of gold, which is usually associated with cheap money and inflation, remained stable and even declined during most of his tenure. Gold was $461 on August 11, 1987 when Greenspan took office, and fell to about $250 during his term. 18 years later, the day he left office, it was $569. These prices are consistent with sound monetary policy. Also during his term, the dollar hit modern-day highs and its strength became a factor during his term. Deflation was an issue during his term, but never inflation. This also is consistent with sound monetary policy and inconsistent with alleged inflationary finance. No matter who or how many say Greenspan set rates artificially low, creating easy money, the housing bubble and the subsequent credit crisis, they cannot get away from the evidence above. Every one of the points above contradicts these allegations. Greenspan was in line with all other market interest rates and the inflation rate, which is to say he followed the market. If it was indeed low interest rates that caused the real estate boom and credit crisis, the market that was the cause, not Alan Greenspan. The cause of the real estate boom was a combination of irrational exuberance among investors and home buyers mixed with demographics. Baby boomers started positioning themselves for retirement and bought second homes throughout the world. The baby boom happened in every nation that fought in World War II. In addition to the 77 million boomers in the U.S., foreign boomers were also buying real estate around the world, a large part of why 26 other nations experienced real estate booms at that time. Investors, especially retirement-focused boomers, had shifted away from a risky stock market due to the tech crash of 2000. They moved their investment money into safe real estate where prices were less likely to fall. Many home builders and professional investors soon became real estate speculators. The general population that actually needed to move to another home simply got caught up in the frenzy. Years before, when Greenspan was asked why we were not experiencing recessions as in the past, he answered, "To my knowledge, the business cycle has not been repealed." He was reminding us it's when things look rosiest we should prepare to duck. But it is not the job of the Fed to prevent booms. Their job is to ensure a stable national price level, provide liquidity in times of financial stress, and act as a bank of last resort to protect against systemic failure. The business cycle is a product of free markets. It's inherent in capitalism. Since markets are the reflection of all individuals' values, emotions, perception, and expectations, it follows that these factors will always be in flux. It has been said that the stock market moves between greed and fear. Well, all markets do that. Markets act like a pendulum and swing back and forth over long periods of time between complacency and optimism, exuberance and panic, and then after a long healing process they swing right back to comfortable complacency. This arises from human nature. The business cycle is as natural as the changing seasons. The period we've just come out of is typical. We went from the pessimism created by the dot-com crash through a 5-year stagnant stock market replaced by a period of real estate investment, and then, just as you would expect, into real estate speculation. Investors jumped from the stocks they'd just take a beating into real estate, something that they knew could not go down in value. Since default and bankruptcy rates were nil and investment gains were unusually high, lending and borrowing practices grew lax. The use of leverage increased and fraud and deception grew unchecked. In effect, good times begot bad times. Complacency led to stability, and because things were so good for so long, stability led to euphoria, and of course euphoria led to malinvestment, overconsumption, and the misallocation of resources. This kind of market behavior can be a product of government's ability to create artificial booms, but it can also result from human response to any kind of boom, real or not. Hence the business cycles of the 19th and 20th centuries. Add to this one more unusual factor. China and the other emerging markets were in their greatest period of growth in history. Wealth was being created at an unprecedented pace. As wealth increased, savings increased. This new supply of savings helped finance the world real estate boom. The money supply in the U.S. was growing normally, but the world money supply was exploding. Interest rates fell to their lowest level in history. But the credit crisis in the U.S. was unique, and the cause was massive nationwide fraud, incompetence, and ignorance combined with unprecedented leverage. Fraudulent mortgage underwriting by financial institutions and applicants, false appraisal values by appraisers, buyers en masse ignoring the terms of their adjustable rate contracts, and sellers enticing them with teaser rates and liar loans all set the stage for systemic failure. But the death blow came from a recent marketing invention in the form of packaging subprime loans by banks and non-bank institutions. In the past, loans were made by the banks that kept the loan. But the packaging of loans became popular during the boom, and soon prime loans were sold together with subprime and fraudulent loans. Normally the market would reprice suspect loans and they would be discounted to a price that would clear the market. But because they were bundled into a package and sold as AAA loans, they were not visible to the market. In effect, there was no effective market to deal with bundles of loans. There was no way that the market could identify and price these suspect loans. The loans were not transparent. There was no way for the market to know how many bad loans there even were, or to what degree they should be discounted. The market hates uncertainty, and that's what we got. The market for all mortgage-backed securities dried up. What cannot be seen or defined cannot be dealt with. The credit markets froze. In a nutshell, this is what caused the financial panic and contagion that ensued. The Fed is charged with maintaining price stability, and that it did during Greenspan's tenure. However, there is one charge against Alan Greenspan that may be true. It has been suggested that the Fed took too long raising interest rates, and that it should have moved faster to raise rates from 1% to the 5.25% that Greenspan eventually moved them to. Greenspan is a gradualist. He believes in allowing the markets to adjust gradually to monetary policy, hence he raised the federal funds rate 1/4% at each Fed meeting. It is possible that rates were kept lower than they would have been if they were free to float. It is possible that a free market in the Fed funds would have led to a quicker return to the 5% range Greenspan eventually took the Fed funds rate to. Yet given the fact that almost all rates immediately turned down again and are back at the levels that prevailed during the Greenspan period, unless only history will judge the merits of that argument. Yet this man of great integrity and honesty is accused of creating bubbles, manipulating the money supply, interest rates and the economy to the point of bringing America to its knees. And all without showing even a hint of remorse. And it has long been an open question whether central banks have the technical ability to maintain stable prices. Their repeated failures to do so suggested that they did not, whence in part my preference for rigid rules. Alan Greenspan's great achievement is to have demonstrated that it is possible to maintain stable prices. He has set a standard. Other central banks around the world, whether independently or by following his example, are following suit. The time-worn excuses for central bank failure to stem inflation will no longer do. They will have to put up or shut up. Milton Friedman, WSJSA, January 31, 2006.